Walk into any retail trading forum, and you will find people hunting for the exact same thing: a magic entry signal, a specific combination of mathematical indicators that points to the perfect moment to buy, practically guaranteeing a profitable trade, known in the industry as the search for the Holy Grail. Millions of retail traders lose their capital because they build their entire market strategy around finding this single predictive trigger. To actually survive in the market, we have to stop treating technical indicators as crystal balls. Instead, we must view them strictly as mathematical state estimators. These tools exist solely to take millions of raw historical transactions, price and volume, and categorize them into actionable data points. Look at this chart displaying the MACD indicator. Historically, these visual setups appear foolproof. At points A and B, the MACD line crosses upward through the signal and zero lines, a classic buy signal. The math aligns and price surges. But relying on technical analysis solely to engineer a perfect entry is a foundational design flaw. True long-term edge is engineered through mathematical expectancy and risk management. The first step in dismantling the entry signal fallacy is examining how trend indicators are actually constructed and why they possess zero power to predict future price movement. Here, daily price action is plotted against multiple simple moving averages. A 50-period average simply adds the last 50 closing prices and divides by 50. A common entry trigger occurs when a faster moving average crosses a slower one from below. When this crossing action happens, the state of the market is officially defined as bullish. The mathematical trap lies in the construction itself. Because the line is derived entirely from an average of historical closes, it is merely confirming an event that has already occurred in the market. It is lagging, not prophesying.
We see similar limitations when traders attempt to use bounded indicators, also known as oscillators, which are mathematically constrained by hard upper and lower limits. Oscillators are designed to flag when an asset is overbought or oversold, operating best in a sideways market. But when an asset locks into a strong trend, the oscillator pins itself to a bound, generating false signals. Because all entry math is historically lagging or bounded, even the most valid signal will eventually bankrupt a trader lacking a structural framework. To find more robust market signals, institutional developers shift their analytical focus away from lagging trend lines, looking instead at the speed of price changes and raw volume. This Relative Strength Index, or RSI chart, measures momentum. It's a bounded oscillator tracking the speed of price movements from 0 to 100. When the blue line crosses the upper threshold of 70, the asset has risen so rapidly that it has exhausted the pool of immediate buyers. These zones mark where price is overextended relative to its recent average, creating the mathematical conditions for a reversal. The most robust signal this tool offers is divergence. This occurs when the price makes new lows, but the indicator is already trending higher, signaling that the downward pressure is losing strength despite the lower price. We see this same anomaly applied to volume in this accumulation distribution chart. The price chart at the top is clearly making higher peaks. However, the underlying volume math is failing to make a higher peak. This negative divergence warns that the upward trend is likely to stall. Divergence is a powerful tool, but identifying a high probability anomaly only grants a trader permission to enter the market. By itself, it is still not a complete trading system. Investment coach and systems expert Van K. Tharp identified a structural wall that most retail participants hit. An entry setup, no matter how accurate, accounts for a maximum of 10% of a successful trading model. Tharp proved a system must solve 3 mandates before a dollar is deployed. First, how to protect capital when the entry fails. Second, how to objectively define the exact moment to secure profit. Third, how much capital is allocated to ensure survival over many trades. Operating in the market without strictly defining these 3 parameters is not system trading, it is functionally gambling. To solve Tharp's mandates, we have to recontextualize our technical tools. We stop using them to predict entries and start using them to engineer strict exit parameters. Take this chart displaying the average true range, or ATR. Unlike an oscillator, the ATR is an unbounded measure of pure market volatility. It calculates this true range by measuring the asset's average movement, specifically factoring in any sudden price gaps between trading periods. Instead of using volatility to find a breakout, a developer uses an expanding ATR to calculate a dynamic, volatility-adjusted stop-loss. This ensures a trade is only aborted when the market moves outside its normal statistical noise, fulfilling the first mandate of capital protection. For the second mandate, taking profit, we look to counter trend parameters. This chart uses a Fibonacci retracement, plotting percentage lines based on mathematical relationships to create objective price targets. Because prices often retrace a significant portion of a previous trend before resuming, the math dictates highly probable resistance zones. Here, the system can automatically trigger a profit exit the moment price hits the 61.8% retracement. An alternative method for setting profit targets relies on volatility envelopes, like these Bollinger Bands, plotting standard deviations above and below a simple moving average. By tracking statistical extremes, a trader uses swings within the outer envelopes to establish automated profit-taking zones. Utilizing these math-based indicators to dictate exits removes human emotion from the trade execution, quantifiably improving the system's probability of survival. But the final, most critical layer of system architecture is the math that bridges the entry and the exit: position sizing. Position sizing dictates that the amount of capital allocated per trade must be dynamically scaled. The calculation is based entirely on the distance between the entry price and the ATR-defined stop-loss. Look at the equity curves of two identical systems suffering a string of 10 consecutive losses. The system using arbitrary sizing takes a static monetary loss on every trade, plummeting the account value toward zero. The second system risks a fixed fractional percentage of the total remaining equity. As the account drops, the absolute dollar amount risked shrinks proportionally. The bleeding stabilizes. Proper position sizing prevents mathematical ruin, ensuring the trader stays in the game long enough for their system's probability to play out. Position sizing is the actual engine of wealth creation. The entry signal is merely the ignition switch. A viable trading strategy is a cohesive architecture. We use technical tools strictly for their correct purposes. Moving averages and momentum oscillators process the raw data to condition the market environment and define the entry trigger. Volatility parameters like the ATR and Fibonacci sequences execute capital protection and secure the objective profit. When combined with a strict position sizing algorithm, the ultimate output metric of the system is positive expectancy, the statistical probability that over a large sample size of trades, the strategy will generate profit. The mechanical precision of risk metrics replaces the need for a magic signal. Market Edge is built through internal mastery and rigorous system design.